It's been a rough year for United Healthcare. Of course, we all know the hostility against the company culminating in the public attack that shocked the world. But today we're going to talk about the actual business of United Health Group and why the stock is down 50% over just a couple of months. Spoiler alert, it does not have to do with Luigi. I will discuss the reasons for the sell-off, the risks of investing now, and of course, the possible opportunities. UNH stock was known for being one of the best dividend growth stocks in the market, and this sell-off could be a once-in-a-decade chance to buy. It now trades at a very low profit multiple despite a reliable track record of growth. In fact, the starting dividend yield for UNH stock is now the highest in the history of the company. And historically, this is one of the best performing stocks in the entire market. If we go back to 1990, the total return for United Health Group stock prior to this recent sell-off was over 203,000%. So should you be buying the dip? Well, before I get into that question, I want to let you know that the summer sale for dividenddata.com is now live. This is the best tool to help you find better dividend stocks. You can get 50% off our annual membership and lock in that discounted price for life. This is the best deal we ever offer, and if you join right now, you get a free bonus gift. It's an educational product that I just spent a lot of time building. It's called Master Dividend Investing in 7 days. It includes a 90-minute video lecture outlining my stock analysis framework and investing strategy. Plus, you can get curated lists of top stocks so you can get started fast. Examples include the top 10 dividend growth stocks and top 10 high-yield dividend stocks. The link is in the description and pinned comment of the video, and it is only going to be available for a limited time, so now is the best time to join. With that said, let's roll the intro and jump into this UNH stock analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. So before we get into the news about why the stock is selling off and my thoughts around that, let's take a big picture look at the financials of UNH stock. And the reality is that it's very impressive. As you can see, their non-GAAP earnings per share has grown year after year after year. And in their most recent quarter, they just had all-time high in earnings per share. And based on earnings per share over the trailing 12 months, the stock is currently trading at a 12.7 PE ratio. And with a forward-looking annual dividend payment of $8.40, that gives it a 2.76% dividend yield. As we take a look at the key financials, you can see that revenue per share for United Health Group stock is growing very fast and reliable. The 10-year compound annual growth rate is 12.37%. And to be honest, this is a beautiful chart. It almost looks like a subscription software company like Salesforce or something. However, the margins are definitely different compared to a software business. We have gross margins of 22% and net margins hovering between 3 and 6%. If we take a look at the free cash flow per share for United Health Group over the long term, you can see that it has had very high growth, although fiscal 2024 was down from 2023 and 2022. This puts the 5-year compound annual growth rate only at 5.27%, which is a large slowdown from the 10-year CAGR of 12.61%. However, from that lower base, they still had $22.29 in free cash flow per share during fiscal 2024. And based on today's stock price, that means the company is trading at 13.6 times free cash flow. And again, no matter what you think, that's objectively a very low multiple for a company with a reliable growing business. They have a strong balance sheet with assets far outpacing liabilities and shareholder equity of $95 billion. They currently have $34.2 billion in cash and short-term investments. However, this business does have a large amount of debt with $81.2 billion of total debt as of the latest quarter. So they actually have more debt than they do cash. That gives them positive net debt currently at $46.9 billion. So this is currently the most negative thing we've come across so far. But I've analyzed businesses with way worse. The reality is that United Healthcare is a cash flow machine, and they have used that to pay a growing dividend. This is a quarterly dividend payment that they have been doing since 2010, where they switched from annual to quarterly, and the dividend growth has been fantastic. The 10-year compound annual growth rate of the dividend is 18.8%. The 3-year CAGR is 13.14%. The most recent dividend increase for UNH is 11.7%, so it is slowing down, with the one prior being just under 14%. The payout ratio for UnitedHealthcare stock currently sits at 36.3% based on free cash flow, which is very sustainable. So this dividend is very safe and they have plenty of room to even reinvest in growth. The net income-based payout ratio is a little bit higher at 52%, but that is still in a very sustainable range. And previously that has been as low as 30%. And as I mentioned earlier, I used the AI analyst over on Dividend Data to look at UNH dividend yield. And we can scroll down and see that the dividend yield for UNH stock is the highest it's been really in the entire history of the company. So purely in terms of the dividend, this seems like a great buying opportunity if you were already interested in UNH stock. The yield did get slightly higher as we're not currently at lows for the stock, but 2.8% is still an extreme outlier. On top of dividends, the company also repurchases shares, although that has been pretty slow in recent years. So those are the historic financials for UnitedHealth Group, and to be honest, it looks pretty good if you're looking for a dividend growth stock. But a big question is what's going to happen moving forward? What are the future earnings of the company? On dividenddata.com, I have the analyst projections for earnings per share, and that goes all the way through fiscal 2029. So the consensus estimate currently is down 17% year over year for fiscal 2025, but this is still very high earnings per share given their current valuation. For context, that would be a 13.4 P ratio. However, analysts are still projecting the company to grow earnings per share in the double digits in the years after. The estimated earnings per share for fiscal 2029 is $40.83, which at today's stock price is a 7.4 P ratio. Purely in terms of valuation, this looks like one of the most compelling stocks in the market. The current consensus price target among Wall Street analysts is $413.63. That implies the stock is 35.74% undervalued. The lowest price target is $270, so based on that assumption, it could have some room to go down. Overall, analysts still have an overwhelming buy rating on the company. So why is the stock selling off? Well, I did write a newsletter about this a couple weeks ago when it first happened, but to add to that and get an even more updated look, I asked the AI analyst, what is the latest news with UNH, and what are the reasons for the sell-off? And there are actually quite a few, which would make sense because the stock's down 50%. First off, in the latest quarter, they revised their 2025 earnings outlook downward, with adjusted earnings per share now expected between $26 and $26.50. That is down from previous expectations of $29.50 to $30. And if we go back to our consensus analyst estimates, that's where they get this 17.7% EPS decline. But I'm pretty sure they base this number off of GAAP earnings per share. Other factors are the company is experiencing an increase in care cost. In their earnings call, they noted physician and outpatient services being the highest cost increases. It came in at about double the expected rate. Other operational challenges was in their Optum Health business. They're transitioning to a new risk model. I'm not an expert in the healthcare industry, so I can't give you much insight there. And it's those factors that I would say are responsible for the first 30% sell-off. However, there was another major news story that caused the stock to sell off an additional 27%, and we still remain at these depressed levels. And that is legal and regulatory issues. UnitedHealth is facing a class action lawsuit alleging securities fraud and other unlawful business practices. Additionally, there are allegations of Medicare fraud and a criminal investigation by the Justice Department. And it's this Medicare fraud report that really sent the stock down. I believe that was a Wall Street Journal article. And we really don't know any details yet about the investigation and what the potential penalties could be, or really like the significance or whether it's even happening. However, around that exact same time that report came out, the CEO of UnitedHealth Group, not the guy that got killed, that was in UnitedHealthcare, which is a subsidiary of UnitedHealth Group, the top CEO, Andrew Whitty, decided to depart from the company. He cited personal reasons, and this combination of the CEO stepping down, plus these allegations of a criminal investigation and Medicare fraud. I should also mention that when the CEO stepped down, the company withdrew its 2025 guidance, adding to the uncertainty even more. And that, ladies and gentlemen, is how you see a stock fall over 50% in a couple of months. But this could be a long-term buying opportunity if a lot of those fraud allegations don't really amount to much. And as we stand right now, we really don't have any clear information or data around that. So a high-quality dividend growth stock that even I had on my personal watch list has now sold off and rocketed to the top of my dip finder. The stock is down 41.86% from its 200-day price average and down 30% from its 50-day price average. And if you stick around to the end, I'll be doing a discount cash flow analysis on UNH stock. So first off, opportunities. It's pretty obvious. It's significantly cheaper in terms of valuation now. This is also one of the largest healthcare companies in the United States, and they do have scale advantages compared to competitors. As long as healthcare costs keep rising, which they have been for decades, the company will continue making more and more money. They'll likely have slow to flat membership growth, but inflation of medical costs does lead to higher revenue. This will likely continue being a cash flow machine, really no matter what happens with these news stories. And they also do have a history of weathering regulatory scares. Now, the risks are also obvious. We have the DOJ Medicaid fraud investigation. And the reason why this matters so much is Medicaid is a big part of their business. So if they were doing some sketchy things to juice their earnings in that category, then not only could they face punishment and fines, but it could impact their earnings as well if they have to not do those practices. The other thing is that there's huge uncertainty around their leadership and future guidance. Also, politically, people hate this company, and that could lead to additional regulatory scrutiny. They are also already at a very high scale for health insurance, so there's not necessarily a lot of organic growth ahead. But if the historic financials are any indication, the company should be able to continue growing their earnings over time. But a lot of that is based on managing cost. And finally, this is probably the biggest part, the unknown unknowns. Not only is there a lot of uncertainty, but we really don't know a lot about these stories. So you could imagine even worse scenarios that could cause the stock to go down even more. But in the same vein, the stock price has already sold off from these unknowns. So we might already be in that era of opportunity. And to highlight that once again, I did a discount cash flow valuation using the AI analyst over on dividenddata.com. You can type in any stock. For example, I did UNH DCF valuation, and it will fill in all of the data with verified financial metrics. And it even has this customizable calculator that you can use to edit the future projections. But with the baseline case of assumptions, the implied share price for UNH stock is $346. That implies 14.6% upside from here. And that is assuming 0% revenue growth in 2028 and 2029. It is also based on the stock trading at a free cash flow multiple of 9.78. So if we up that to even something a little more reasonable like 15, which is still conservative, that puts the implied share price at $482 with implied upside of 59%. So if you were actually bullish on the company and thought they could have high revenue growth well into the future, and you think they deserve to trade an even more premium multiple, then this stock objectively looks pretty undervalued. So that wraps up my UNH stock analysis. Please do your own research before making any investing decisions. I personally do not own this stock as healthcare is kind of outside of my area of expertise, and I haven't done a deep dive on their various business models. But on the surface, the financials look great. And if you want to use the stock research tool I've been showing throughout the video, it's all available at dividenddata.com, and now is the best time to join. We just started our summer sale where you can get $150 off annual membership. This is the best price we ever offer, and there is a 30-day money-back guarantee, so no risk in trying it out. Just click the link in the description and pinned comment of the video to get access to this sale. And if you join right now, you get a free bonus gift, which is a course I spent a lot of time making over the past month. It's called Master Dividend Investing in 7 days, and it really explains everything you need to start dividend investing. And only this week you can get that free bonus when you sign up for dividenddata.com. So use the link in the description and pinned comment of the video. And thank you for watching. Please subscribe for future stock analysis content. See you in the next one.